Welcome traders, and in this video we're going to be looking at why traders fail. So let's have a look at what can actually happen when it comes to because obviously we have traders who win, and it's all good looking at the positive statistics to see what we can do right, but also we need to find out what we can learn from, how we can learn from our mistakes and then overcome the mistakes to become that winning trader. So here's an account that unfortunately didn't make it. It did in fact hit its equity stop down, as we can see here. But if you have a look at sort of the advanced statistics and find out exactly what happened, and then see what potentially we can how we can help this trader in order to actually become a more profitable trader, or at least a break-even trader, because it is quite a difficult task even to maintain break-even performance before you actually start then to analyze your trades and further in-depth broaden your knowledge, so that you can actually create a better strategy to just boost that probability a little bit further and then become a profitable trader. So here we can see total trades is 13, profit deals 5, loss deals 8, short positions 8, long positions 5, profit factor 0.11. Profit factor could be a little bit higher here. So the best profit was £7.36, with the biggest loss being £23.18. So obviously we want to keep our winners bigger than our losers. So automatically already we can see that our losses are pretty much 3 times as big as our wins, or in this case if we look at the best profit and then the best loss. If you actually look at the best loss as well in terms of account size, £23.18, it's roughly 1%, and when traders should be building that buffer for themselves when they actually do go into profit. Unfortunately, I don't think this trader did go into very much profit before they went into drawdown, but we do need to try and get this buffer of profit per week before we can start building towards that profit targeting and getting to that next funded level. We need to make sure that our risk is much smaller than 1%, especially if we want to build up a skill set over many trades, because it's obviously not possible just to know whether you're a winning trader just by simply placing, let's say, 5 trades at 1% risk, because then you've only got 5 trades to base all your performance off. So if we continue looking at the statistics, we can see here average profit £3.09, average loss again much higher at £17.85, expectancy -9, with the average trade length there. So yeah, let's have a look at statistics, symbols. There's many positions opened on many currency pairs now. That's something that I have said it in the blog before. You want to stick to just 2 or 3 currency pairs which you feel comfortable with. You can then build upon those and then learn those characteristics about those currency pairs and better your knowledge and understanding about what's going on in the economics. If you are trading a dollar pair, then understand what's happening with the dollar, what's happening with the Fed news, all of the dollar index stuff as well. If you trade in a pound, what's happening in the UK, etc. But there's many pairs here which your trader has been getting involved with. So yeah, let's scroll down and have a look at some of the history then. So there is 2 pages of results here. So not a huge amount of trades here at all. Started off with some small profits. This trader was using stop loss and take profits, which is first step, good to see them actually placing those levels. But then obviously it went a little bit sideways and then went pretty downhill from there, losing this trade here, which was roughly 0.5%, then this trade, and that's what we tend to see. When traders lose, tend to make that first loss of a big loss, maybe it is 1%, 1.5%. They tend to try and chase that back quite quickly, again trading another New Zealand pair here, Euro USD, USD Swiss, and then finally the GBP USD. Finally brought that to just below the stop out level, unfortunately. But as we can see here, we can only use a small sample of trades, so it tends to come into the factor whether it's going to be luck is on your side when you are trading such a small amount of trades. What we want to do is we want to use our skill sets as profitable traders to actually trade long term. So when you are, especially building that initial buffer on your new prop trading account, you want to, as I say, even if you are risking 0.25% and you're placing, let's say, 5 trades per week, 10 trades per week, then over the sample size, you're going to get a better understanding of exactly what's happening. You can obviously manage your risk depending on a certain trade situation. If it's going to be a much longer situation or a short-term trade, then obviously adapt it to however it suits you, but keep that risk right down to a very minimum. We can see this trader didn't break the 1.5% rule, which is always good. He did implement all of the stop losses in play here. I would say perhaps focus on a limited amount of currency pairs, perhaps choose 1 to 3 maximum. Even using 1 currency pair is a good idea when looking at building more sustainability within those pairs, and then you can actually trade more of a long-term basis where, let's say, you're looking at, for example, the euro versus a dollar and then the USD CAD. Obviously, you're only going to be looking at those 2 currency pairs, so your view of bias isn't going to get skewed because you're only focusing on those 2 charts. You can then look for precise entry points on those pairs, and then obviously you can be placing trades, let's say on the euro versus dollar. That trade may last a day, 2 days, and then you're going to take a little short break, see what happens, and then move on from there. So really it all comes down to the amount that you're risking and the amount of pairs that you're looking at for in this situation here. You want to keep that loss small and the winners big. It's easy to say, but it is such a big part of becoming that profitable trader. And I know I always do say you got to risk super low, but the thing is, we have some pretty small profit targets in terms of getting to that next level. It's only 10%, and obviously if you was to do, let's say, 5% per month, 10% over 2 months, then you're going to get a increase in capital onto level 2, which is times 4 capital, and then every time you hit your profit target, and from that it's another doubled amount of capital all the way up to £1 million. So the thing is, you do need to focus on the long term. And let's say you are only making 5% a month, then if you're placing, let's say, 5 trades per week, around about that, then risking 0.2, 0.3, 0.4% on a setup is to potentially make, let's say, 1%, 1.5%, 2%, or even more, depending on risk reward ratios, is obviously going to be pretty significant. So bringing that risk all the way down and risking as small as possible in terms of building up that buffer, so then you can actually go on to maintain profitability all the way up to your profit target. Okay, so if we take another look at another example then, so a slightly bigger account where unfortunately it did in fact end in a stop out. Let's have a look at what happened then. So right from the beginning, obviously we can see the stop out hit here. Not the account didn't really go into much profit. It just went straight into a drawdown, brief bit of profit, and then continued into further drawdown. Total deals 92, profit deals 45, loss deals 47. So I've seen many profitable traders actually carry a fairly similar profit to loss ratio, looking at their total trade sample, and still be profitable. So this makes me think that automatically it is an issue with risk to reward ratios and where they're actually cutting out their trades. If we look at the short position 21, long position 71, profit factor 0.44. Again, ideally you want that slightly a little bit higher if possible. Best profit £52. Biggest loss here, as we can see here, £131.15p. Average profit 15, average loss again £32.99. We need this the other way around. We need to make sure that we're cutting the losses much shorter than the winners. But you know, this is a super difficult. It's such a difficult skill to possess, especially when you actually when you do face losses on your account. Then it's quite difficult to actually come back, and especially when you're in a trade. You know, obviously we have other things to do in our lives, potentially full-time jobs, other commitments, etc. But just maintaining that level-headedness and understanding exactly, you know, the fact that we need to be building capital. So that means cutting losses short, letting winners run, you know, banking those profits when you see, you know, when the opportunities a good position to. So it's about, you know, trying to build as much capital as possible by doing the correct risk reward management. Expectancy -9 and average trade length 0.5. So again, I think this really comes down to risk management and risk to reward ratios. As we'll go to in depth in the order history in a moment, we can see symbols, so many symbols. Again, they are trading gold, so mostly forex, but obviously commodities here as well. Gold at around 5% of their trades, but we can see here the amount of trades here is quite significant, and in terms of clarity and the ability to focus on you know, news and technical analysis across all these pairs would be very difficult for any trader to do. So as I say, 2 to 3 currency pairs. It's not limiting your ability on looking at amount of potential on the market, because there is still huge amounts of potential. There are many traders who are trading 6 figures, 7-figure traders who are looking at, you know, 2 to 3 currency pairs, potentially even 1 currency pair for some of those traders, and still able to make serious gains and huge profits out of the market. So let's scroll down to the order history then. So there's quite a few pages of trades. So we can see here started off relatively okay, building up a nice little buffer to begin with at the very start. Let's just see here on the growth chart. Okay, so it looks like this trader potentially had many traders open at once, again using fairly small lot size, which is good to see. Always using that stop loss take profit. As we can see here, there is many trades where the take profit isn't even set. So it's great that they're placing stop losses, but as I've mentioned in other blogs, the exit point and when you're getting out of the market, so that point where you're targeting, where you're looking to get out of the market, is the vital part. It's super important when it comes to your trading setup. It's like, you know, getting onto that train. As I mentioned before, if you get on a train in a certain direction without any destination, then, you know, it's not going to lead to any good, because obviously you don't know where you're getting out of, and it's only going to lead to confusion. Same with your trades. You know, you need to have that exit point where you're actually going to be pulling out, and it's part of your trading strategy. You know, where is your risk to reward? What's the reward going to be? You need to be calculating all of these levels, all of these different things, in order to, you know, build you into that profitable trader. But getting out of the market and having a plan of how you're going to do that is super important, even before you get into the trade. When you're in the trade, then you can adapt and you can see what's happening. Maybe news is going to come out or a trend has changed, then you can adapt and see when you're going to be getting out in the market next. But having that take profit in place, that at least the levels placed, is a vital part of trading success. Let's look a little bit deeper then. So we can see here again, every trade stop loss but no take profits. Amounts seem to be relatively small here. A large period of losses here, small losses. Again, you know, 1% on this account, you know, around 17,000. So we're looking at, you know, 160 to 170 pounds loss for would be 1%. So we can see here these losses are good that they're relatively small, but if you have a look here, I can imagine that there's a lot of trades here that were placed at the same time. Looking ahead, continued loss, mixed losses here. Again, some profits, some losses. Moving along. Okay, losses starting to slightly creep up. and winners similar, staying the same. Winners, yep, profit deals similar. And then yeah, losses start to creep up. So again, when it comes to the building blocks of actually learning how to build that winning streak or more of a winning formula to at least become a break-even trader, if not profitable, you want to be in that mind frame of always wanting to earn the right to actually trade bigger. So when we place our trades over and over again, we obviously want to find more similar trades and repeat them over and over again to get that large sample size of are you a profitable trader or not, essentially. But we don't want to increase our losses or increase the amount of loss that we could potentially make as we go along. Only if we are actually trading at like a high profitable rate. Obviously, if you are earning the right to trade bigger, then obviously increase that lot size slightly. But if you haven't found any success in certain strategies or methods, then if anything, you should decrease your lot size and then earn the right to trade bigger over more of a trade sample size, so you can see what's going on. And then when you are actually making profits and you're trading well, making those correct trades, all the decisions are correct, and you're journaling it, and keeping to that strict type risk management parameters, then you can increase the lot size and then look for more modest profits from your trades. So that's it for this episode. Just briefly going over some of the potentially flip side of all the positive wins and winning traders who are making withdrawals through our prop firm. It's always good to see what's actually happening on potentially the other end of the scale, other end of the spectrum, when traders potentially don't quite get there to the profit target and unfortunately hit their stop out. So yeah, make sure that you obviously look for keeping the amount of currency pairs that you're looking at a small rate. Risk to reward parameters need to be on point, and then looking at the levels which you need to exit the market out of is crucial. So that's it for this episode. Drop any ideas, please give us any feedback on any other topics or anything you want to cover regarding prop firm, our prop firm, any questions related to how we deal, our system and the accounts that we manage. And stay tuned for more blogs to come. Trade safe.